If you had told anyone at the start of 2026 that silver would rocket from $32 an ounce all the way to $121 in just a matter of weeks, and then crash 43% within days, most people would have laughed you out of the room. But that is exactly what happened. And the story behind it. It leads straight to China. Welcome back to the channel. Today we are going to break down one of the most dramatic commodity price events in modern financial history. We are going to explain how Chinese traders and China's government policy unleashed a silver surge the world had never seen before, why it happened, how it collapsed, and most importantly, where silver is heading from here. Let's get into it. To understand what happened in January 2026, we need to go back a little. Silver had already been climbing steadily throughout 2025, driven by growing industrial demand from the solar energy sector, the electric vehicle revolution, and the explosion of AI data centers. Unlike gold, silver is not just a financial metal, it is an industrial powerhouse. Today, nearly 60% of all silver demand comes from industrial use. Solar panels alone consume close to 30% of the entire global industrial supply. But even with all of that demand growth, supply was not keeping pace. According to data from the Silver Institute, 2026 marks the sixth consecutive year of a structural supply deficit in the silver market. That means the world has been consuming more silver than it produces for 6 straight years. Inventories at the major exchanges, COMEX in New York and the London Bullion Market Association, were already at historically low levels heading into 2026. The market was a powder keg. All it needed was a spark. That spark came in October 2025, when the Chinese government announced it would be implementing strict new export controls on silver, effective January 1st, 2026. Now, this might sound like a routine bureaucratic policy change, but the scale of what China controls in the silver market cannot be overstated. China accounts for between 60 and 70% of the world's refined silver supply. Let that number sink in. More than half of all refined silver on the planet flows through Chinese hands. Under the new policy, only large, state-approved companies would be allowed to export silver. And even those companies would need to meet 2 strict conditions: an annual production capacity of at least 80 tons of silver and special government export licenses. This effectively shut out hundreds of smaller and mid-sized Chinese exporters who had long been the backbone of global silver supply chains. The moment this announcement hit the markets, traders around the world began scrambling. The panic buying had begun. Sprott Money's analysis laid it out plainly. The silver rally that followed was not a Western-driven speculative bubble. It was a rally emanating directly from China on very real physical supply concerns. And as long as those concerns remained, the rally would have staying power. Here is where it gets really fascinating. For decades, silver price discovery has been controlled by futures traders on the COMEX in New York and in London. But what happened in January 2026 completely broke that pattern. All eyes shifted to Shanghai. By the third week of January, the Shanghai Futures Exchange was setting the pace for global silver prices. On January 22nd, Shanghai silver was trading at $104 per ounce, while COMEX sat at $94. The very next day, Shanghai jumped to $112, while COMEX followed to $2. By January 26th, Shanghai hit $123 and COMEX rocketed to $117. The signal was unmistakable. Wherever Shanghai moved, COMEX moved within hours. Chinese physical demand was now the engine of the global silver market. What made this so unusual was that the commitment of traders' data coming out of COMEX told a surprising story. Typical speculative blow-offs involve speculators, hedge funds, and retail traders, piling into long positions and driving prices higher. But that was not what was happening. The speculative positions and keys of positions in COMEX silver were actually shrinking, not soaring. Instead, the buying was concentrated in the swap dealer and producer merchant categories, entities dealing in real physical silver. This was not paper speculation. This was physical demand driven by genuine scarcity fears. There is a deeper structural issue that the China story exposed, and it is one that market insiders have warned about for years. The silver market like most commodity markets, is dominated by paper contracts, futures, forwards, ETF, and derivatives that represent claims to silver rather than actual physical metal. For the system to function smoothly, most participants have to be content holding paper exposure without ever demanding real delivery. But here is the problem. According to market analysis from FX Street, the current paper-to-physical ratio in the silver market stands near 356 to 1. That means for every 1 ounce of physical silver, there are 356 ounces worth of paper claims circulating in global markets. When Chinese buyers started demanding physical delivery rather than paper exposure, the fracture lines in this system began to show. Physical premiums. This signaled that buyers were desperate for real metal, not promises on paper. The silver market was effectively splitting into two worlds, one where physical silver existed and one where it only existed on spreadsheets. The Great Silver Squeeze of 2026 had officially begun. Silver hit an all-time high of approximately $121.64 per ounce on January 29, 2026. The metal had surged 65% in January alone. Citigroup, one of the world's largest investment banks, was calling silver gold on steroids and forecasting it would reach $150 within 3 months. And the euphoria was at peak levels, then came the crash. On January 30th, 2026, what markets have now dubbed the Warsh shock, news broke that Kevin Warsh had been nominated to succeed Jerome Powell as the next chair of the Federal Reserve. Warsh is known as one of the most hawkish voices in central banking. His nomination signaled a potential end to easy monetary policy, rising interest rates, a stronger dollar, and a less favorable environment for non-yielding assets like silver. The market reaction was instant and violent. Silver futures recorded their worst single-day decline since 1980. Within days, prices collapsed from above $117 all the way down to approximately $64 per ounce, a fall of more than 43%. Billions of dollars in paper wealth evaporated almost overnight. U.S. Treasury Secretary Scott Bessent publicly attributed the extreme swings in the metals market to Chinese traders, describing the peak as a speculative blow-off. But analysts who had been tracking the COMEX data pushed back hard on that characterization, pointing out that the speculative position data simply did not support the blow-off narrative. The real drivers were structural, not speculative. As of today, February 21st, 2026, silver has recovered significantly from its February lows. The spot price is trading around $84 to $85 per ounce, historically very elevated, but a far cry from the January peak above $121. The market has entered a consolidation phase, trying to find equilibrium between the bullish structural fundamentals and the new macroeconomic reality of a potentially more hawkish Fed under Warsh. The broader macro picture has actually been supportive of silver. U.S. retail sales unexpectedly stalled recently, and GDP data has come in softer than expected. This weaker economic backdrop has shifted expectations back toward Fed rate cuts, with markets now pricing in approximately 60 basis points of easing by year-end. That is bullish for silver. Meanwhile, the U.S. dollar has been trading near 4-year lows, which historically tends to boost precious metal prices. The Silver Institute's latest data shows that global silver supply is expected to reach a decade high of 1.5 billion ounces in 2026. But demand remains robust enough that the deficit continues. Physical investment demand is forecast to rise 20% this year to around 227 million ounces, a 3-year high, as investors rush back into real metal after the volatility of January. So, where does silver go from here? There are 3 plausible scenarios playing out in the market right now, and you need to understand all 3 before making any decision about this metal. In the most bullish scenario, silver continues its recovery and pushes back toward the $90 to $109 range. The structural deficit is real. China's export restrictions remain in force. Industrial demand from AI infrastructure, electric vehicles, and solar continues its relentless growth. and the Fed delivers the rate cuts the market is expecting. Citigroup's $150 forecast might look ambitious right now, but bullish analysts at Gold Silver argue that the supply deficit alone, now entering its sixth consecutive year, makes a retest of the highs not just possible, but likely before year end. In the base case, silver consolidates in the $70 to $85 range for the next several months. Volatility remains high, but prices hold elevated levels as the market digests the Fed leadership change, Chinese policy, and global industrial demand soaks demand. The gold-silver ratio, currently anchored with gold targeting around $5,000 per ounce, would put silver fairly valued in the $75 to $90 range based on historical ratio norms. This is probably the most likely near-term outcome. In the bearish scenario, Kevin Warsh moves aggressively to tighten monetary policy. The US dollar strengthens sharply, risk assets sell off, and silver retreats back toward the $60 to $65 range. If Chinese industrial demand weakens at the same time, perhaps due to a slowdown in solar installations or EV production, the demand side of the equation gets hit simultaneously. That combination would be very negative for silver prices in the months ahead. And in months ahead. Here's the question every serious investor should be asking right now. Is the January 2026 silver surge a one-time shock event? Or is it a preview of something much bigger? If X Street's analysis put it powerfully, silver's recent rally is not a speculative anomaly. It is the inevitable outcome of years of underinvestment, export controls, and industrial overconsumption. China's policy shift has only accelerated a trend that was already in motion. Inventories are collapsing, deficits are widening, and industrial demand is rising relentlessly. There is also a geopolitical dimension to this that most mainstream coverage completely misses. Emerging market central banks have reportedly been quietly accumulating silver through third-party entities and sovereign funds, building strategic stockpiles without formal announcements. Saudi Arabia has been reported to be gradually accumulating silver via ETF, not for quick speculation, but to build a store of value that is harder for Western powers to freeze. Silver is quietly being upgraded in the minds of governments from an industrial commodity to a strategic national asset. And the numbers tell a stark story. Total silver demand in 2025 was approximately 1.1 billion ounces. Industrial uses alone accounted for roughly 60% of that. Without silver, there are no efficient solar panels, no electric vehicles, no 5G or 6G networks, no advanced semiconductors, and no AI data centers. The world is electrifying at an unprecedented pace, and silver is the critical metal sitting at the center of every single one of those technologies. The story of Chinese traders in silver in 2026 is not just a trading story, yet it is a story about the collision of geopolitics, industrial policy, supply chain vulnerability, and the fragility of a financial system built on paper promises rather than physical reality. Silver went from $32 to $121 and back to $84 in the span of 6 weeks. Now, that kind of volatility is extraordinary. But underneath the noise, the signal is clear. The world needs more silver than it produces. China controls the supply, and the industrial demand is only going to grow. Whether you are an investor, a trader, or just someone trying to understand what is happening in global markets, silver is a metal you cannot afford to ignore in 2026. If you found this breakdown useful, please give it a thumbs up and subscribe for more in-depth market analysis. Silver is a metal. Drop your silver price predictions in the comments below. I want to know what you think. And as always, nothing in this video is financial advice. Do your own research, consult a professional, and trade responsibly. See you in the next one.